Hello and welcome. You're watching the Small and Mid Cap Show here on NDTV Profit. I'm Harsh Saita. With me is Mahima Vachajani, and we're going to talk to Aditya Shah, who's the founder of Hercules Advisors, about the life insurance pack, because that pack is buzzing on the back of the fact that you have the IRDAI coming in and talking about the surrender value and changes with regard to surrender value, making it more favorable for policyholders and consumers to take back some of the policies that they have subscribed to. Now, to try and break this down a little bit more, especially from an insurer standpoint, Aditya Shah is with us. Welcome, Aditya. Good morning.
Uh, Good morning, Harsh. We've seen that clarity is emerging, and what IRDAI is saying is that in the near term, when the policies are issued, insurers must provide some good surrender value to customers. Clarity has emerged. That's a good point. This is negative for most of the life insurers. Now we can debate about how much negative is for which insurer. To some insurer, it will be more hit. Some insurers, it will be lesser hit. But uh, on the whole, it is negative for the life insurer. So what this basically means is that if somebody has got an endowment or a participating plan, insurers should offer a higher surrender value to customers. This IRDAI has done in order to protect the policyholders. Uh, we should recollect that life insurance has a massive amount of mis-selling that really happens. So from that perspective, it is good from a from a policyholder perspective, negative entirely for the sector per se. But over a longer period of time, this should curb mis-selling to some extent, and then the insurance sector should move forward from that. So overall, negative in the short term, positive in the longer term.
Understood. Aditya, I want to understand that from a company perspective for all these life insurance companies like HDFC Life, SBI Life, ICICI Pro, what changes will happen to these companies and what does this actually mean for all of these life insurance companies?
So let us get down to the genesis of selling these products. Generally, a participating or a non-participating plan or a ULIP plan or an endowment plan generally come with a higher margin. They come with a margin of about 30 to 40%, whereas a pure pay protection term plan comes with a margin of about 15 to 20%. So what the agents generally tend to do is they tend to push the participating products, which give them a higher margin also. Now, this is pure play mis-selling of products that is really happening. And what IRDAI is saying, of course, if you have done mis-selling of products, we will give policyholders a chance to give back the policies. And when policyholders give back these policies, you need to give a higher surrender value. So net, what is happening is that IRDAI is trying to check the insurance mis-selling that is happening. Over a longer period of time, value of new business margins, VNB, for most of these insurers will tend to come down. Now, how much it will come down, only time will tell. For those who have a higher participating plan, or those who have a lower proportion of term plan in their business, will be the ones who will be the maximum hit. For example, in my opinion, somebody like an LIC or somebody like a Max Life, or to some extent somebody like an HDFC Life would be the ones who would be the maximum hit.
Okay, Aditya, got it. Talk to us about what your sense is with regard to companies pivoting their products as well as uh, tweaking their products to actually suit the current regulations. What companies you believe are well placed for that? Because it will require some amount of tweaking from a selling perspective as well. So that's one. Second is from a commission standpoint. What changes actually?
So we've seen private insurers like HDFC Life, like ICICI Pro Life, pushing term plans. The growth on term plans is spectacular for those insurers. Uh, Public insurers like LIC are still lagging behind in term plans. Mind you, insurers make anywhere between 50 to 100% profit margins on a term plan. They are just not being pushed because commissions for agents are really lower there. So now what I feel is going to happen is most insurers will try to push term plan, and private insurers are really very well placed there. LIC needs to really catch up there. First point. Second point is From a commission perspective, I think that insurance companies will try to trickle down this higher surrender value to commissions, and commissions on participating, non-participating ULIP endowment plans would start to see a hit. They should start to lower, because companies do not want their margins to get lowered down, because their valuations will then get hit. So my perspective is commissions uh, on all other investments plus insurance plans will start to come down. Commissions on term plan will stay. Companies will start to push term plans, and companies will try to protect their margins to maximum extent possible first.
And therefore, Aditya, do you believe there are enough levers in the system to help some of these companies maintain their margins?
Yes, definitely. So enough demand for term plan is already there. Some companies are growing their term plan portfolio by about 30 to 40%. So enough margin, enough room is available so that companies can protect their margins. In my opinion, a 1% or a 2% margin hit is the maximum that most of the private companies will take. For companies like LIC, which has a huge portfolio other than a term plan in the insurance and the investment product portfolio, there we need to clearly understand what is going to happen, because nearly about 80 to 90% of LIC's products are insurance plus investment portfolio that we have seen.
Understood. Aditya, any view on which of these companies have the highest one-year retention rate?
So highest 1 year retention rate, of course, LIC continues to be amongst the highest. HDFC Life also is having one of the highest retention rates. As well as something interesting on HDFC Life and ICICI Pru Life is their growth on the term plan side of it over the last 2 to 3 years has been extremely aggressive. HDFC Life is trading at about 30% or 30% VNB, value of new business margins, and 25 to 30% for ICICI Pru Life as well. So I expect all the private insurers to stay in the band of 25 to 30%. Some of them could take a short-term hit, but over a longer period of time, 25 to 30% hit. And I also expect LIC to start concentrating on pure play term plans even more aggressive.
Got it, Aditya. Now, I want to try and understand the levers. So one is, of course, you've spoken about commissions, especially commissions linked to surrender as well as surrender value will likely go up and likely start to get built in. Talk us through what the current commission structure is like, if at all you can give us some insights on that. And where do you see it go? Because that will be one of the largest levers. Outside of that, is there any other lever which companies can use except growing non-par quickly to try and maintain or at least not dilute margins in a big way?
So commissions, I have the figures on the participating in insurance and investment products. Companies pay anywhere between 30 to 40% of commission. And mind you, these premiums are really very high. The premiums can range from anywhere between 50,000 to 1 lakh rupees a year. So companies tend to pay about 30 to 40% of their premium as a margin, as a commission to the agent. So this, I think, will start to reset downwards as companies see more and more surrender in the policies. Also, companies could adjust commissions based on the surrender value. So, for example, in some year, if a customer tends to surrender their policy, then the commission could start to be adjusted downwards. That's the first point. What was the second question that you really asked?
So
Yeah.
outside of commission, what are the other levers that can help margins?
So I forgot to mention this, that apart from the participating plan, on the non-par and the pure play protection plan, companies only pay about 20% margins. So 20% commission. So what I think the companies will start to do is, companies will start to lower the margins, lower the commissions on the participating and investments and insurance products, and start to increase the commissions on the term plan. So what this will do is, term plans are really very profitable for the companies. 50 to 100% profit margins are there on term plans. So this will try to protect the margins that companies have really got. And over a longer period of time, margins will tend to be anywhere between 25 to 30% on the private insurer side. Other than these, I don't think that companies have any other levers that they can really work with. If any of these private insurers have their margins eroded well below 25%, there would be an erosion in the profitability of many of these companies.
Understood. Aditya, one last quick question. You know, the entire insurance space, I mean, all of these insurance stocks have underperformed in the past 6 months to 1 year. But something like HDFC Life is up, you know, almost 3% today. So going forward, where do you see the value then, your top picks, basically?
So my topic will continue to remain with HDFC Life because HDFC Life is one of the most aggressive life insurers. Over the last 1 year, they have seen an integration of with Exide Life, and they have seen the product portfolio slowing down to some extent. So my topic will be HDFC Life, but I will also look at LIC, where I will look at what improvement LIC is making within their term plan portfolio and within their new business margins. So number one pick, HDFC Life, a close call on LIC with respect to the improvements that they really make. And also I will like to monitor the sector for the improvements in margins that happen over a period of next improvements, or if somebody is not able to control their product portfolio, if the value of new business margins, which is a very important metric to track, falls below 25% for any of these life insurers, then it could be really very interesting that those stocks could get a de-rating.
Okay, thank you so much for all of those insights, Aditya. You know, it's an interesting space to watch out for, not only because of the underperformance, but also because of the number of things that are changing in the space and the sector at all points of time from a regulatory standpoint. So thanks so much for breaking this down for us.
We're also joined by Anushi Vakharia, who tracks the real estate space. You know, the focus today is Valor Estate, and they've recently decided to demerge their hospitality business from the real estate business. Now, to discuss more about this, we have with us Mr. Rahul Pandit, who is the CEO of Valor Estate, who joins us now. Welcome to the show, sir. My first question to you is that, you know, demerging the hospitality business from the real estate business, I want to understand what is the kind of value unlocking that you're seeing here, and what is the key rationale for demerging the two businesses, and going forward, what are the key initiatives and plans for the hospitality business?
Thank you, Mahima. It's good to be chatting with you, and good to represent Valor Estate to you. So the key rationale for doing the demerger essentially is three things. First is value unlocking in the sector, especially given the strong macros in the environment. And also, as you know, that Valor's business primarily is real estate. And after the demerger, the hospitality's intent is to create a strong, sustainable EBITDA portfolio. And both the businesses also will attract different sorts of capital stack, delivering superior returns. So that's the intent. And currently, our intention is to create a 4,300 keys, upper upscale and luxury portfolio in the country in some of the densest micro markets across Bombay, Delhi, and Goa. So currently, we have 484 keys operating between two assets, which is the Grand Hyatt Goa and the Hilton Mumbai. We are in the midst of creating India's largest integrated hospitality development at AeroCity Delhi, which is a 4,000 crore capex project, and it's going to be released by the end of next year. So this will have India's largest integrated hospitality complex, which is a 779 keys development of St. Regis and Marriott Marquis, along with 600,000 square feet of office space and 200,000 square feet of convention space. In addition to this, we are developing 3 assets in some of the most marquee micro markets in Bombay, which is Sahar, BKC, and Worli. So at Sahar, we are developing a 970 keys hotel along with 450,000 square feet of office. At BKC, it will be an 1175 room hotel with 200,000 square feet of convention space. And at Worli, it's going to be an 800 room hotel. So those are our plans right now.
So, Mr. Pandit, Anushri joining you from the other side, I wanted to understand that you've laid out quite a big plan for the hospitality business going forward. But if I were to look at the number of key contexts, we're almost seeing about a 10x jump. Wanted to just understand the kind of growth picture that we are to expect for this fiscal, that is FY25, and going forward to about 2030, about 10x jump in the number of keys. So what is the kind of number should we look at from the current 200 crores that we have seen in hospitality to in the next 5 years?
Okay, Amishi, it's a good question. One is to say, what's the theory supporting this growth? And second is, what numbers are we looking at? So we are expecting a stabilized EBITDA in excess of 1,000 crores for this portfolio. And to take a quick look at the macros, if you see in India, the aviation sector, which has 771 planes in the sky, and there are 1,400 new planes that have been ordered. So minus 200 aircraft, which are replacement, this is a 250% jump in our air capacity. And similar macros are going to play out in hospitality, and especially today, where demand is outpacing supply. So we think that our addition of supply to key micro markets will deliver sustainable EBITDA over the continued long term.
Sir, you guided for 1,000 crore kind of number. Could you give us a timeline for that?
Yeah, so we expect this to be in FY30.
Understood.
When properties, which are under development, they also stabilize. So currently, we are also going to see a jump up. So as I told you, by the end of next year, the combo assets at Delhi Aerocity, they are going to operationalize. And post-stabilization, the EBITDA of those assets is going to be 500 crores. And it's a 50-50 JV with Prestige. So our share, our economic interest is going to be 250. And once we add the 3 hotels in Bombay, this will be 1,000 crore EBITDA portfolio.
Understood. And that's all on the hospitality side of things. Can I also get some insights with regard to the real estate side of things? How is the execution pipeline looking like? What are the new projects that you're going to be coming in with? And what are the numbers that we're going to start seeing FY25 onwards?
Sure. See, on the real estate side, we currently have over 31 million square feet, which is under development in MMR. And along with that, our land parcel is over 498 acres today. And interestingly, Valor, if you see BSE Sensex, it's delivered a 30% increase over the last year. And at Valor, we have delivered about 200%, 197%. So these strong fundamentals are going to continue. And we have a more B2B focus. So we are working with, large reputable developers to bring in, land parcels and supply to fruition in MMR.
Sure, sir. Now coming to the debt side, again, our focus had been to decrease the debt going forward. But now with the addition of more of these land parcels and the kind of hotels that we want to add going forward, how is the debt going to look like? And are we looking for more funding plans in the future?
Thank you. That's a good question. So one of the key imperatives of doing the demerger is also to effectively make Valor debt-free. And essentially, the new debt would be on the hospitality projects. And, hospitality, it's EBITDA generating and long-term gestation assets. So the total capex outlay is going to be about 9,000 crores. And we are looking at a 1:1 debt is to equity plan for the portfolio.
Understood. Well, Mr. Pandit, thank you so much for giving us those insights and taking out time and speaking with us at NDTV Profit. It was a pleasure talking to you. But with that, it's all that we have on the show for now. Stay tuned for more news and updates on NDTV Profit.